Hey everyone, welcome back to the show. Thanks for tuning in. We're going to be continuing along with our trader checklist today, and we're going to talk about covered calls today. So we've covered a few different option strategies where we're dealing specifically with options and solely with options, but today we're going to look into one of the strategies we use where we combine long stock and where we're selling a short call against it to reduce our cost basis, and we're going to go through the checklist to see exactly what we're looking for with this trade. So when we break it down, we've got a covered call, which is really just buying 100 shares and selling an out-of-the-money call against it. Now, unlike the other strategies that we used, this trade is routed for a debit when we route it together rather than a credit, which is what the other trades we've covered in the last few days have been. So let's first break it down on the next slide by talking about what the covered call is and what we really like to use this for. So really, it's our go-to strategy when we're looking to become long stock because we can reduce our cost basis. So there is a notion of not knowing where an underlying is going to go. No one really knows where an underlying is going to go. We can have assumptions or opinions on certain things, but that doesn't guarantee that something's going to move that way. I've seen plenty of earnings announcements, for example, where they've beaten their expected earnings per share, but somehow the stock comes down. So we don't really know where an underlying is going to go, but if we focus in on something like cost basis reduction, which is exactly what this strategy is, then it puts us in a great position to be successful. So we do also like this strategy because we not only don't need that stock to move up significantly to be profitable, we can actually be profitable if the stock doesn't move at all. Since we're collecting a credit for this short call, we are able to profit if the stock doesn't move, because at expiration, the credit we received from this short call will be able to be turned into profit or cost basis reduction, which would move our cost basis down just a little bit, but that allows us to close out those shares for a small profit if the stock price does not move at all. So because of this, we have a neutral to bullish assumption. We have a neutral assumption if the underlying does not change at all. We're still going to be profitable because of that short call that we're selling. But ideally, we are going to have a bullish assumption because in a perfect world, we want this stock to blow through our short strike to get us close to that max profit potential that we have on the trade. A high IV environment is going to be beneficial for a few reasons. We're looking for that high IV not only because we know that implied volatility is a reflection of the options prices. So option prices drive implied volatility. So when implied volatility is high, that means that the option prices are also high. So if I can collect a higher credit for selling this call than compared to a lower volatility environment, that's going to be great for me. And also, just the notion of a high implied volatility environment means that there is a larger implied move. So if I'm long shares of stock and there's a high implied volatility environment, I wouldn't be surprised to see that stock go very far up or very far down when we compare it to a lower volatility environment where the stock might move just a little bit. So in a high IV environment, it can help us become profitable if the stock does go through our short call. And if it does go against us, it's still going to be okay, because if we compare being long shares of stock outright, if the stock goes down and we don't sell this call to reduce our basis, we're going to lose a lot more than if we had sold this call, which is why this is our go-to strategy whenever we're looking to become long stock. So let's go to the next slide and we'll walk through exactly the same thing when we're looking at what happens when the stock goes up, stays the same, or goes down. So when the stock goes up, it's sort of counterintuitive because you're going to see your short call losing money. So if you're looking at this trade on the Doe platform, for example, you'll be able to see your long 100 shares on one line and you'll see your short call on a separate line. And when the stock is going up, your short call is actually going to gain value. But as we talked about over the last few days, when we're selling an option, we don't want it to gain value. We want it to decrease in value because that's going to allow us to buy it back at a lower price. So when we see the stock going up, you're going to probably see your short call lose value, or gain value, I should say, which is going to result in a negative P&L. But those losses will be totally offset by the long share gains. If we remember, a short call will turn into short 100 shares of stock at expiration. So regardless of where the stock price goes, it can go 20 points higher than our short call, and we'll see a $2,000 loss on the short call, but we'll also see an extra $2,000 gain on our long 100 shares of stock. They call it a covered call because this short call is completely covered by the 100 shares of stock that we own. So any gains on our short shares that we see past the short call here, we're going to see in losses on the short call. But really, the short call is there for the extrinsic value that we received in the beginning of the trade. Even if our short call is completely breached at expiration, we're going to be okay with it because the call is going to be trading for roughly intrinsic value, which is really just the difference between where the strike is and where the stock price is at a current point in time. And those losses of intrinsic value on the short call will be completely offset by the long 100 shares we have, which would be benefiting from that upside move. So it can be a little counterintuitive when we're just starting off with this sort of strategy, but this is exactly what we want, and that's why I've got it highlighted in green here. We're also going to be profitable if the stock stays the same. So comparing it to a naked long stock situation where if the stock price stays the same and I purchased it here, I'm not going to be profitable at all. If I purchase the shares at, let's say, $50 a share, and the stock price is at $50 a share a month later, I haven't made any money. But if I purchase them at $50 a share here, and I sold a call against it, and let's say I collected 50 cents for the call, I would have effectively reduced my cost basis by 50 cents or $50, as long as that short call expires out of the money. So now my cost basis is $49.50 as opposed to $5,000, even though I can still sell those shares back to the market if it's trading at $50 exactly for $5,000. So I've reduced my cost basis to $49.50. I can then go out and sell those shares for $5,000, which results in a $50 profit. So here I've got this highlighted in green as well. And the important thing to note here is that theta decay is working for us because we sold that call. Every single day that the stock price does not move, although we're not making money on the shares, this call will lose value over time because of that theta decay effect going in our way. And because of that, we're going to be able to either A, let it expire out of the money completely worthless, or buy it back for a lower price if we're really focused on holding on to those shares. If the stock price goes down, it will lose value in the call will lose value. So the call price is going to go down, which means that if we sold it here and the price of that call is losing value, we have the opportunity to buy it back at a lower price, or we can look to maybe roll it down to collect some additional premium and move our break-even price even further to the downside. Of course, the shares are going to lose value because if I purchase the shares here and the stock price goes down, my long shares are going to be worth less. But when we compare it to just owning those shares outright, the covered call scenario is going to be a better position in all situations because of the fact that regardless of where the stock goes to the downside, I will definitely lose less if I sell a call against those shares than if I had just purchased those shares outright. And that's because of that credit I'm receiving from selling that call. So we've talked about what happens when the stock goes up, stays the same, and goes down. Of course, when the stock goes up, that's the best case scenario. If the stock stays the same, that's also great for us. And we can see a losing position if the stock does go down. But a covered call is always going to be better than a naked long shares position because of that credit we're collecting here. But what are some for this strategy? Well, first of all, we're going to look at calculating the break-even price. When we're looking at the break-even, instead of looking at the strike price and using the credit as a means to calculate the break-even, we're actually going to be looking at the share price here. And that's because we are routing this trade for a debit. So we need to realize that we are buying 100 shares of stock and we're selling one call against it for every 100 shares of stock that we own. So to calculate our break-even, all we need to do is take that share price. So let's keep it the same at $50, and let's pretend I sold this call for 50 cents. All I'd have to do is take my share price of $50 and subtract that credit of 50 cents from it. That would bring my break even down to $49.50, and that obviously is a better break even than if I had just purchased those shares outright at 50. The IV factor is, of course, going to be better when we have a higher IV situation. So we talked about having high IV in a covered call position a little bit earlier, and what it does is it allows us to collect even more for that call, but just like some of the other strategies where we can move further away, it's the very same here. So if I've got the shares at $50 and we're in a very high implied volatility environment, instead of maybe selling this call at 55, which would be out of the money, maybe I can move it even further out. Let's say I can look at the 60 strike for collecting 50 cents because we're in a higher implied volatility environment. Now, that gives me a lot more room to the upside to be profitable, because instead of the shares going up to 55 and that's where I'd be capped out there, my max profit would simply be the distance between where I purchased the shares and that short call plus the credit received. So if I purchased it at 50, sold the 55 call for 50 cents, I would have a max profit of $500 plus that credit received of 50 cents, which would bring me to $550. But if we're in a high IV environment and I can move this strike from 55 to 60 and still collect 50 cents, now I've got 10 points of wiggle room to the upside. So if the stock price goes past 60, what will happen is I'll be able to profit $1,000 on those long shares because I purchased them at 50 and now my short call is at 60. So let's say I collected 50 cents, I would have $1,000 of wiggle room to the upside for my shares to gain value, and my short call, by selling that short call for 50 cents, I can tack on another $50 to that max profit, which brings me to $1,050. So the high IV environment not only allows us to collect more from this short call if we keep it on the same strike, but it allows us to move it further out if we want to look to collect around maybe 50 cents or $1. We're going to be able to move it out a lot further and give our shares much more wiggle room to the upside for profit potential. When we close this position is really going to depend on what our goal is with the shares. So a lot of people like to do covered calls in portfolios where they're really looking to hold onto those shares for the long term. So I beg you to ask yourself, what do you want to do with the shares? Do we care about losing the shares? If we don't care about losing the shares, then personally, maybe I would look to hold the short call to expiration. That would allow me to fully capture all of that extrinsic value that I sold from selling that call originally. And if I don't care about the shares being called away, at expiration, I would just close that trade for max profit if the stock price was above my short call. But if I was really focused on keeping those shares, I would maybe look to close my short call out a little bit earlier. So if I really want to keep these shares and maybe I'm at 50% of max profit of my short call, I would definitely consider closing out that short call, because if the stock price goes up and I don't have that short call anymore, then I'm definitely going to be able to keep the shares because there's nothing inhibiting me from keeping those shares like the short call would if it was on. Because again, the short call would turn into negative or short 100 shares of stock at expiration, which would completely offset our long 100 shares, and the brokerage would leave us with no position. So if I wanted to hold the shares, I would look at maybe managing this call and making sure that I'm not called away. But if I don't care, maybe I'll look at holding that to expiration and capturing all of that value from the extrinsic value side that we're looking to sell when initially putting on this trade. But let's wrap all this up with some takeaways for you so we can get it all together. So the very first takeaway is we've got a neutral to bullish cost basis reduction strategy. This one is really focused around cost basis reduction because we've already purchased the shares. A lot of the other option strategies we're dealing with out shares. We're just looking at specific options, and we can use that profit to theoretically reduce our cost basis if we are assigned later in time. But since we are already long shares here, we are going to be focusing mainly on that cost basis reduction aspect of it. A high IV environment is best, just like all the other situations where we're selling an option, and that's not only because we can collect more from that option, but also because we can move it further away and give our shares much more room to the upside to profit from when we're in a higher IV environment. And we also need to consider what we want to do with the shares. Do we want to hold them? Do we want to make sure we hold them for a year or 2 years because we have a longer bullish upside bias? Or are we just putting on this trade because we're looking for a nice trade where we can make some profit if the shares go up and also collect an additional credit? So when we look at when we need to close this trade, we need to consider those things. And also, playing defense on a covered call we've got a lot of options. And if you haven't seen the 3 covered call adjustments whiteboard, I definitely suggest checking it out. I'll include it in the description below when this video is archived. So thanks so much for tuning in. This has been the Trader Checklist for the covered call. If you've got any questions or feedback, shoot it over to one of these emails here, or you can follow me on Twitter. Stay tuned though, we've got Jim Schultz coming up next.